In the world of Forex, one of the fundamental concepts every trader must master is lot size. While it may initially seem like a technical term, understanding it is essential for managing risk and crafting effective trading strategies. Lot size refers to the amount of the base currency you are buying or selling in a trade. In simpler terms, it is the standard unit that defines the volume of a transaction in the Forex market. Although the concept of lots is not exclusive to Forex, in this market it has unique characteristics that set it apart. In Forex, lots are categorized into three main sizes: standard lots, mini lots, and micro lots. A standard lot equals 100,000 units of the base currency. For instance, if you're trading EUR UUSD with a standard lot, you're buying or selling 100,000 euros. This lot size is commonly used by traders with larger accounts, as it requires significant capital and involves higher risks. For those not ready to handle a standard lot, there's the mini lot. A mini lot is 10,000 units of the base currency, where each pip is worth approximately $1 on major pairs. Finally, the micro lot is the smallest, at 1,000 units of the base currency. This size is ideal for beginners, as it allows for practicing strategies and managing risk with less financial pressure. Why is understanding lot size so crucial? The answer lies in risk management. In Forex, every pip, representing the smallest price movement, has a monetary value determined by the lot size you are trading. For example, trading with a standard lot means each pip is worth $10. A 10-pip unfavorable movement could cost you $100. However, with a micro lot, each pip is worth just $0.10, significantly reducing the impact on your account. Lot size is also directly linked to leverage and margin. For instance, trading a standard lot on a 1/100 leverage account means you need a margin of only $1,000 to open a $100,000 position. However, leverage amplifies both profits and losses, making the choice of the right lot size even more critical. So, how do you choose the appropriate lot size? It depends on factors such as the size of your account, your risk tolerance, and your trading strategy. A general rule of thumb is not to risk more than 1 to 2% of your account on a single trade. For example, if you have a $1,000 account, ensure your maximum loss per trade does not exceed $10 to $20. This will help protect your capital and avoid over-leveraging. In summary, lot size is not just a number on your trading platform. It's a key tool that can determine the success or failure of your trades. Choosing the correct lot size allows you to control risk, trade with confidence, and achieve long-term sustainability in the market. Whether you're a beginner or an experienced trader, mastering this concept is a crucial step on your path to Forex success.